let's start with financial forecasting in OpenAir. So this is a pretty big topic in the OpenAir system, and there's lots to cover. But first I want to let you know where we're going to be and where you might run into us in person. So we do have OpenAir user groups throughout the U.S., and we have one actually tomorrow in the Boston area. So those of you who are on the phone, let us know if you'd like to join that if you haven't signed up already. It'll be in Burlington. And then we have another one next Friday in the Minneapolis-St. Paul area. If you'd like more information, you can go to our website or certainly just send us an email afterwards. Our next webinar series in the August timeframe is going to be communication planning. So we're going to talk about all the ways that email notifications can be customized or turned on or turned off so that you use the email capabilities effectively as a communication device in your organization. And then, you know, in the fall, lots of conferences are going on. Just wanted to highlight one. We are sponsoring the TSW conference. We'll be at an expo booth. So if you happen to be attending that as part of the TSA organization, we'd love to see you stop by our booth and say hi. But on to the topic of the day, which is financial forecasting. So we have quite a large agenda, and what I'm going to do first is just talk as an overview about, you know, sort of what OpenAir does for forecasting, and then I'm actually going to take a little bit of a turn and talk about different ways forecasting can be accomplished in the system and not necessarily just the standard out-of-the-box functionality. As you may know, we're using the OpenAir system. It can process actuals from time capture all the way through to invoicing and revenue recognition. So there's a number of elements in the system that you have to set up and sort of execute in order to get from end to end. You know, setting up rates and billing rules, creating projects, capturing time and expenses, then running those rules to create those charges and those invoices. So that's the actuals of the system, and you can always run reports to get, you know, sort of what has happened in the system. But the thing about the OpenAir system is it sort of takes that same framework and it reuses it in its core forecasting functionality, which is called charge projections. So instead of, you know, actually creating invoices, we project what we would create, or we project billing. How do you project billing? Well, you take the rules and you process future time or future events, future milestone dates. And what's the future time? That hooks into your resource scheduling activity. So you still have the projects, you still have the rules, just like you're setting up the infrastructure for actuals. But the fact that you can sort of plan out your resources, plan out your schedule, that can be used as future time, which then runs through the rules to come up with future billing. And that's what OpenAir wants to do, is it wants to do that bottom-up detailed calculation. Now, having said that, I kind of boil things down into, there's kind of 4 methods to forecasting in OpenAir. There's 2 standard ones that people use all the time. One is charge projections in the system. This is the standard functionality in OpenAir, the bottom-up calculation, taking your schedule of resources or your plan of time and running it through the rules to come up with projected billing. There's a variation on that called straight line forecasting that we'll also cover, which is really a simplistic, you know, date, start date, end date, budget spread across the time. So not a lot of detail, just an approximation. But as we work with customers, we find that there's other things that customers are looking for as far as forecasting run rates, for example. And you can actually use resource scheduling as a way to sort of forecast a run rate. There are some, you know, pros and cons with this, and actually it's a good way to sort of, you know, do a comparison of the actuals in the system. We'll touch on that a little bit more in detail. And finally, a new feature that came out in the April release, which is called Project Budget. So I look at this as a forecasting method because it simply gives you the ability to plan out your budget weekly, monthly, quarterly, by detail activities such as different types of services, different types of expenses, and sort of plug it into a manual spreadsheet. I've had customers ask for this kind of forecasting before in OpenAir until this feature wasn't really able to support that, but now it can. So let's go into the charge projections. This is a larger topic on the financial forecasting, just so you can see what it takes to set it up, what decisions you have to make, and some configuration or data control items that you have to put into the system in order to accomplish certain forecasting accuracies. So forecasting by default, just the core functionality in OpenAir, is called charge projections. And what it does is it basically takes some type of indication of forecast time in the system, and we'll talk about what that means. And it runs it through the rules in order to compute projected values, projected billing, projected revenue, projected billing cost, information like that. If you're not familiar with what charge projections are, it's actually a whole setup section inside the OpenAir system. Oh, you don't care about that one. And you don't care about that one. Third time's a charm. So it's in the administration module under the application settings, project settings area. And in here you'll see charge projections. And the charge projections are where you can configure the system and tell it how you want it to compute. What does it use as its future time to compute the forecast. The status section tells you the last time it was run. And it also will give you a status of whether it's currently running or not at the time. The thing about charge projections is it's a global control in the system. So it's not something that you can say, practice 1, I want to forecast this way, practice 2, I want to forecast a different way. It is a global decision that you have to make. And one of the decisions, the core decisions, is what is the source of information from which you'll forecast your time. So the options include timesheet data, includes resource scheduling items such as assigned hours or booked hours, and then it also includes combinations, approved and booked, worked and booked. And I'm using the standard OpenAir terminology in this webinar. So booked hours, you may have renamed those to things like allocations or something like that. So the first thing you have to do is tell the system, hey, point to this type of data in order to use that for my future plan, and then take that data and run it through the rules to calculate a projected billing, a projected revenue value. Now, the next part, the next decision you have to make besides the source of data is what is sort of the date control that you're going to use to tell the system how to forecast. And what I mean by that is we termed it something called a pivot date. And what that tells the system is from a defined date forward, calculations will be occurring in the system to do projection. So from that date backwards, everything that's in the quote-unquote projected value list is 0 because it's not going to project historically. It only projects going forward based on the date that you're putting in here. The system actually supports 2 different approaches for the date. And I know there's a number of enhancement requests from the customer base to expand this list. But right now there's really just, it's what's called an absolute date where you're physically typing in, August 1st, 2015. Or there's something called a relative date which says forecast from today forward or tomorrow forward. And that's the list of options that you have for the relative date. What's the big difference between the two, other than the fact that one's sort of a today tomorrow thing and one's a hard-coded date? It really matters most in how you're going to factor the date range of the forecast into your overall reporting needs in the system. So in some cases, customers will want to forecast this month, and this month would be July 1st. If you wanted to set a hard date, it would be July 1st, and I want to forecast from July 1st onward. And there are ways, based on the source of the hours that you're going to use, the calculation will change depending on whether actuals are in the system or if you're keeping the bookings up to date or you're changing the task assignment date. So the absolute date range would be something akin to if you wanted to say, I want to forecast from this month forward. If you were doing something more like you're running billing automatically every day so that you can just invoice whenever you want and not have to worry about running pending billing, you may pick more of a relative date range. I'm running actuals up to today, so I forecast from tomorrow forward. And that's really the difference between the 2 date ranges is How are you using the system? What are you letting the system do automatically? And what do you need from a reporting perspective to make sure you get accurate forecasts? The thing about the pivot date is anything before the pivot date is sort of assumed to be actuals in the system. So continuing with the this month example, running a report in my OpenAir environment, and I forecast from July 1st onward. Anything prior to July 1st, there's actuals in the system, actual billing, actual time, approved time. So I, from a reporting perspective, rely on the fact that actuals are in the system up until my pivot date, and now my pivot date going forward, I focus more on the projected values in the system, projected billing, projected revenue. Those are the two things that work together to calculate the forecast or the projections. So going into the form, you can see you have to tell the system where do the hours come from, and then you also have to tell the system from what point do you forecast forward. Okay. Now in the April release, there were other couple of features that came in there about to be able to exclude projects. Up until April of this year, you weren't able to sort of exclude projects at all. It just grabbed everything and anything it could. And now there's the ability to sort of exclude, to actually exclude inactive projects. That's the ones where the active checkbox is turned off. Or you can exclude entire project stages. So moving projects into like a complete or a lost stage, depending on what your methodology is. You can have those excluded so that you're not having them factor into the forecast at all because they're done. So what's the pros and cons of the different hours sources? So you saw that we could pull approved and worked hours or worked hours from timesheets. So approved hours is an option, worked hours is an option. So I usually get the question of, well, why would I ever use my timesheet for forecast? Isn't that actuals? And honestly, it is actuals, but what the charge projections would do in this case is it would take the hours that are on the timesheet and basically produce something akin to a pending billing type report. It would, if it was approved hours, it would do more of a pending billing report. If it's worked hours, it would give you something similar to a pending billing report, but for those of you who are involved in invoicing, you already know that the pending billing report only works on approved hours. So it's a little bit of a sort of a preview of what you could be invoicing if you use the worked hours. So if you're really using the approved hours or worked hours option on the charge projection, what you're really doing is sort of doing a preview of invoicing. You're not really doing a lot of forecasting, like forecasting as I think in the traditional sense of looking out 6 weeks, 12 weeks, 18 weeks in the future. Booked hours is a pretty common charge projection method because people will use bookings in the system to plan out their resources, schedule their resources to do the work. And because of that, that's your future time, and it acts like a timesheet basically. When it comes to the charge projections, it'll take those booked hours and it'll run them through the billing rules to be able to produce a forecast of revenue or a forecast of billing. And of course, it'll only pay attention to the booked hours from the date that you set on the charge projection, that pivot date. Okay. Of course, like anything in the system, it's only as good as the data that's put in. So of course, keeping the schedule up to date is critical in order for you to get realistic numbers. Assigned hours, this is the other type of resource management approach in OpenAir, which is basically having people assigned to individual tasks on the project and having the start and end date of the project task itself drive the timeline of when the person would be doing the work. This is an option for some companies because of the way that they deliver the services and the detail in their task structure. I do see more adoption of the bookings approach because the bookings give you more flexibility to be able to break things up according to specific weeks or hours per day type thing. But the assigned hours works in a very similar system. But the con here is you definitely have to make sure that the tasks are up to date, so it's a lower level of detail, and you're relying on your PMs to keep that task date information up to date in addition to the planned hours. And then there's a whole series of combinations. So a combination of timesheet data, approved or worked hours, along with the resource scheduling approach, assigned or booked hours. Now, this approach always sounds very appealing, but it does have some peculiarities, I guess I could say, that I would want to make sure everyone is aware of if you select this option. So the concept behind the approved and booked or approved and assigned variations of this are that you would schedule a resource, and as they put their timesheet in the system, the timesheet data would replace what you had done from a schedule. So of course, as your month goes along, your forecast is getting more and more accurate because it's replacing actuals with your plan. Okay. So that's almost perfect solution. But there is a slight drawback as it relates to how time can replace a booking. And that really kind of drives into, the fact that you could schedule somebody for 2, 3, 4 projects, and then the person puts time on their timesheet and they work on maybe 1 or 2 of those projects, but then they work on a project that's completely different. So they didn't work on project number 4, for example. You expected them to work on it, they didn't work on it. So when that kind of scenario comes up, and I've kind of given an illustration here, the system doesn't assume that they're purposely not working on that project. The system can't really do anything. It can't make a decision too much about that project. So what happens is, in this example here, I planned a resource to work on a project 2 hours a day for 5 days, so a total of 10 hours. And then on their timesheet, they enter the fact that they worked actually 10 hours on Wednesday. So they didn't work 2 hours a day Monday through Friday. They just worked all 10 hours on Wednesday. Okay. So those of us looking at that data in the system, we see, well, of course, 10 matches 10. So I would expect the forecast to forecast the 10 hours that were on the timesheet, because Monday and Tuesday were 0 and Thursday and Friday were 0. So there's a total of 10 hours. Shouldn't that replace the plan that was 2, 2, 2, 2, 2, Monday through Friday? What actually happens in the system is if 0 doesn't replace anything by standard functionality. There is an approach that you can take to correct this in the system, to switch. But 0 doesn't replace anything. So as you can see in my forecast line, the system, since it sees blanks on the days the person didn't work, it actually keeps the original schedule. So it picks up the 2 from Monday, the 2 from Tuesday, the 10 that you put on your timesheet, and then the 2 and the 2. So of course now we're forecasting much higher than we would have expected, forecasting something close to 18 hours versus 10, which is, in a small forecast like this, it is a significant jump. The solution to handle this, so if you have seen this type of behavior in your system or wondering why your forecast is higher than you would have expected, there is a feature called the job code override, project job code override. And what you'll need to do is you'll need to turn this feature on. And all it simply does is it tells OpenAir to spend it, and this is my terminology, not the official OpenAir explanation, but it tells the OpenAir timesheet and the forecasting system to reevaluate each of the time entries to make sure that it's accommodating that in the forecast capability cleaner. So it actually will take and substitute the zeros, the blanks, for the 2s. It'll make sure that it replaces the time more accurately. I can't explain why it does that more accurately, but the fact that you just turn this feature on, again, that's the project job code override, it does promote more accurate forecasting, specifically in the situation where you're using a combination of time and resource management method for your forecast. So if you haven't turned that on already and you're in the situation, I would recommend turning it on. It doesn't change anything from a configuration perspective. Certainly doesn't hurt anything by turning it on the system, but it will have an impact on your forecast. Now, I keep talking about hours, 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 and how does that get calculated from a forecasting perspective. So that's great if everyone's T&M, but of course we have other situations, other billing rules in the system, right? Fixed fee on percent complete, expenses, purchases. So what happens from a forecasting perspective with these? If it's anything related to fixed fee, it's going to rely on dates. That's the only thing it can really rely on. If you have something like a fixed fee percent complete, so bill this much information upon completion of this milestone, in the system it'll look at the date of the milestone and it will basically use that as its forecast method. So it's really the date it's really a date focus on your milestone rules. There is one exception. It's the fixed fee percent complete. If you're not using that 100% complete metric, the 100% complete, saying this task is 100% complete, it's going to use the end date of the task. If you have something like 100 hours, or you have hours on the task, it will actually try to compute based on your schedule of resources. So if you're using booked hours, it'll try and figure out the percent complete so that it can project when like a 35% or 50% is actually being hit. But as far as expenses and purchases, there's no forecasting for those. I do mention in a few slides from now an approach that you can use if you really need to forecast expenses. And actually with the new project budget feature, forecasting expenses is actually a bit more of a reality in the system, a bit easier to deal with. Now, when you're dealing with time billing rules, as for those of you who have worked with the billing rules before, they tend to have a lot of controls and configurations, caps, filters, rates. And one thing I wanted to highlight is the filters in particular. When you're dealing with forecasting versus actuals, there's some nuances to be aware of. And specifically, user job coded service are all things that are common between bookings and time, or task assignments and time. But what's not common is time type. Time type is a timesheet relationship, right? Tasks don't have a time type. Bookings don't have a time type. So if you do find yourself filtering rules based on time type to say, oh, only bill, on-site time type or billable time type, if you're using time type on your timesheet, you actually may miss some of your forecasts because whatever method you choose to do the forecasting that's not timesheet related, the booking or the task assignment won't have anything called a time type. So it'll just skip trying to process those hours through that rule because, well, it doesn't have a time type of billable or on-site or whatever, so it'll just forecast 0. The same kind of situation happens with tasks. So, of course, if you're using assignments, a task filter pointing to a task from a forecast perspective would be able to understand the task. But not everyone does. If you're doing bookings, not everyone does bookings to the task level. So if you're booking to the project level and you're telling a time billing rule that it has to look at a specific task, then, of course, when you go to forecast time using the bookings, it will not recognize the fact that those hours belong to that rule because it's filtered on a task and it'll skip over it and forecast 0. So in both of those cases, the solution is there's two solutions. One is if you really do want to sort of keep, you don't want to, well, the two solutions is basically changing one of the rules, any rule that you have where you're filtered on a task or you're filtered on a time type, and add the no value list, like no task, no time type. And if you're not familiar with that concept, let me just go into a random project here. And like here on the task filter, I could say add no task, okay? When you add the no option, no time type, no task, what that tells the rule is, oh, I'll also accept something that doesn't have anything on it. So it'll accept the bookings that don't have a time type or a task on it, for example. And it'll include that information into the rule for calculation, okay? So, of course, usually when you're doing filters on specific tasks or specific time types, the reason is because there's different rates based on the work that's being done. And if you don't want to pick any particular rule to have that no value, okay, what you can also do is then you can set up a rule at the very end, absolutely no filters on it whatsoever, and call it something like forecast only. And what will happen is anything that is related to a specific time type or a specific task rule. It'll skip over those rules and go to the forecast only. So there are ways, if you're seeing a lot of zeros come out of your system, there's a couple of options that you have to be able to correct that from a forecasting perspective only. And of course, this would not impact actuals because actuals would pay attention to the filters that you have in the system. How often should you forecast? So the system does not dynamically recompute forecast every time you update a schedule or put a timesheet in or anything like that. It is a batch job. There are scheduling controls on the configuration of charge projections that allow you to schedule it to run every day, for example. Typically off hours, if you can. Some of you are in global companies where there is no such thing as off hours. But pick a time that should not impact too many people, because if they're running forecast and the forecast is recalculating, it's really a timing game then on whether the information they have is the most up to date. So you can schedule it to run, and midnight is the default in the system. Many of you may or still have that turned on in the system. But there's another option that you can force specific projects to recalculate. So if you're not familiar with this feature, it's something that you have to turn on. It's an internal switch to be able to do charge projections at the project level. And what it allows you to do is go into a project and then basically from the Properties tab force a recalculation. So it will take and it'll rerun the charge projections just for that project. A very quick way to sort of update the forecast if you change resource planning, for example, significantly. Now, the frequency of when you should run it. So the default in the system is every day at midnight Eastern if you turn that on, of course, but you have complete control over when you want it to rerun. And how often you run it and is also dependent on the pivot date you pick. So typically I see the forecasting be recalculated every night, but you also have to consider the fact that the pivot date itself may have to be updated as well on a regular basis. If you're looking to forecast on a weekly basis, you may want to refine your pivot date on a weekly basis. If you're looking to forecast on a monthly basis, your pivot date would be monthly. I tend to align the pivot date with how do you do your invoicing. If you do your invoicing weekly, your pivot date is weekly. If you do your invoicing monthly, your pivot date is monthly. If you're running auto billing or auto recognition, your pivot date tends to be the relative range. The nice thing about the charge projection functionality in OpenAir is that you can play with this and not impact anything in the system except for, of course, the projected values that you're reporting on. So you can, try it with a relative range, run it, see how you like the information, change it back to a monthly, rerun it, reset values to monthly. It's something that you can spend some focused time on and validate the information to settle on what you think is the right configuration and combination for your forecasting effort. There is one caution, another caution that I want to say about time rule caps. So time rules, you can cap the amount of money or the number of hours. And the thing to consider is when you're doing your forecasting, in addition to your pivot date, the idea is the forecast of hours or money should be accommodated by the cap. So you really want to be able to understand when are you going to hit the cap based on your forecast. That's the ideal project management focus. Now, make sure if you're, depending on how you've got your pivot date set up, make sure you've got a switch turned on in the system that allows the system to say, once I'm doing my forecast, make sure I consider the fact that I have already run actual information through this rule. So subtract that from the cap so the forecast is only using what's remaining on the cap. So it's a switch is a consider what has already been billed is really what the switch is. And what that'll do is it'll make sure that your forecast is using the remaining cap versus trying to assume that it can have the whole cap and nothing's been run at all. Because then you could sort of, trick yourself into thinking that you have more budget than you actually do if you're looking solely on the forecast. So make sure you have that switch turned on so that you're considering what's already been burned against the cap before you look at your forecasting. And then there's one other switch one other option on the projections configuration I keep talking about billing and billing rules and running things through billing, but it can also do the revenue projections, projected revenue. But you have to physically turn the checkbox on in the charge projections configuration form to make sure that people know, that the system knows that it needs to calculate revenue as well as the billing, projected billing in the system. We'll go back to that form just so you can see all the options there that we just talked about. So down and around here. So that's the standard functionality in OpenAir. There was a lot to cover there, but it has a lot of combinations, and we work often with customers to try and figure out what's the right combination based on the way that I'm putting data in, the way I'm using data, how I'm capturing my actuals, how frequently I'm doing invoicing. All those factor into how you set up the charge projections. But then another feature comes along. This is a little-known feature called straight line forecasting that's available in the tool. It does leverage the fact that you have to run charge projections still or schedule them to run. But what straight line forecasting does in the system is basically simplifies the system by basically saying, give me a start date, define an end date, and give me the amount of money or the budget for the project. And I'm just going to take that budget and I'm going to spread it between the start date and end date, and that's your projected billing. Okay. It does not actually, it doesn't use rules. It doesn't use resource management. It doesn't use timesheet data. It simply uses a start date and end date and spreads the budget. And there is actually, you can create a custom field with a specific name for the end date control if you want to type the end date. Otherwise, it's just going to use whatever it calculates as its finish date to spread those hours across, or the money across. Okay. A pretty common use for this is using it for proposed projects where you don't really have a good resource plan yet, but it's sort of that pipeline approach. I'm thinking the money's going to come in or hit around this time frame of the year, but you don't have any staffing in place yet. So the charge projection functionality that does the bottom-up calculation wouldn't have enough information to give you any money. The straight line projection would be able to give that to you. And the thing about it is it's actually configured at the project stage level. So you can actually dedicate a project stage and say everything in this stage is straight line forecasting and everything in every other project stage is charge projection. So they can live together in the same environment. And in fact, it's a pretty common setup so that if you're bringing pipeline type information into OpenAir, you can have the forecast be focused on straight line projections for those. And then as you win the work or you start planning out the work, you can move those into stages, those projects into stages that will do the bottom-up calculations with the more detailed data. The straight line projections, just to clarify a little bit more about what it actually does in the system, is, if I had $100,000 and I said it runs from January 1st to April 30th, simple math in everyone's head, 100 divided by 4 months, 25,000 a month forecast. But then you run the forecast and you get something like this, where it goes 2020, 23, 21. Really what OpenAir is doing for this straight line forecast is taking the 100,000 and it's breaking it down to the number of working days between January 1st and April 30th. And it figures out an amount of money per day, or actually per hour. And then it rolls it all back up. So if you want to run it weekly or monthly or quarterly, it would be able to give you the value accumulated back up from the individual hours between January 1 and April 30th. So it may not look as intuitive as you would think, but it does calculate everything down to the working day. This slide just shows some setup. It's a bunch of custom fields, actually, that trigger functionality in the system. So if you, I won't spend too much time kind of reading the slide to you. If you'd like some more information or a copy of these slides so you can sort of set this up yourself and play with it, feel free to ask for that. Now, the next two topics are the other types of what I would consider a forecasting approach, or at least something to compare with your forecast to do some further analysis in the system. And one I'm calling resource scheduling run rate. So the concept behind this approach is if I schedule someone to do the work and they have I have a target bill rate as a company, then that amount of work should bring in X number of dollars. So how can I achieve that in OpenAir? there's actually a way that you can use one of the cost levels on the user record. This is I'm seeing more and more customers adopt this. Use one of the cost levels on the user record. You can have up to 3, so it's usually the third one that everyone sacrifices. And you rename it or repurpose it to really represent bill rate. It's just a money field. It happens to be called cost, so you can rename it. We will rename that to be target bill rate. And then anything that has hours related to it, my booked hours, my task assignment hours, my timesheet hours, all those hours natively now have a reporting value that I can say, give me the cost of those hours, or quote unquote, give me the target bill rate of those hours, because I've basically used the cost structure in the standard reporting in OpenAir to repurpose it to be target bill rate. The nice thing about this is it's very simplistic. The fact that you're putting hours in the system, it would sort of give you that sort of money value as well with the target bill rate. But of course, the big drawdown, and if you have a lot of these in the system, you won't want to use this as a reliable forecast, is it doesn't understand anything about billing rules. It doesn't understand anything about caps or varying rates or anything like that. But it is sort of a quick and simple way to say, how much money would I get if everyone worked full time on this project? Now, you may not necessarily use this as forecasting, but if you think about the approach and the concept behind it, what you could use this for is more analysis against your forecast or against your actuals. Things like, did we discount too much? What's my opportunity loss based on the fact that I did actuals at this, but my target bill rate, if we had done the same work at the target bill rate, how much more money would we have earned? Okay. You could also do capacity planning. People have target hours or work schedule hours in the system. What's the target bill rate of those hours? And that turns around and gives you your capacity for revenue earning in the system. And you can also use it for average bill rate trending. So what's your target versus what your actual bill rate is coming in at, and putting those on graphs or reports. So it's not so much strictly a financial forecast, like you run your company based on this financial forecast, but it's a method to complement your forecast to give you additional analysis information that you may be doing maybe in Excel or doing out of other systems that you can actually do directly in OpenAir. Now, the fourth option here, and this is sort of the interesting approach, is this new project budgets feature. So it just came out in April. I know it's going to continue to be enhanced in the system. It's pulling a lot of data together into a central location. So what it allows you to do is basically take a project's budget and plan out when it's supposed to be burned, okay? Which is essentially like a forecast, but it's done at the project level, so it's sort of that gray area. It's not a forecast where a practice manager would say, we usually burn around $800,000 a month, so I'm just going to forecast 800, 800, 800, 800 in an Excel file and type it in manually. This goes down one lower level, and it's basically per project where you can plan out the burn. And what you do here is you can basically, for each type of expense, for each type of service or labor category, for each type of product, you can plan out over a time period when the burn is going to happen, okay? And if you have this plan, basically you could use this plan as your forecast if you didn't want to have to do any kind of bottom-up calculation. So as long as all the PMs are putting their plan in, you would have the ability to pull sort of your expected budget burn, which is what forecast is at the end of the day. So this is the way that if you wanted to basically have a way to sort of hard code, I think I'm going to hit 75,000 this month, okay, and not rely on the system calculating it or straight line forecasting it or scheduling it or anything like that. You could use these project budgets as a way to achieve that hard coding. Just and I use the word hard coding lightly. I mean just basically typing a number in instead of letting OpenAir calculate it. So really the core here is it's a different type of forecasting. It's a different approach. It does not actually do any calculation, but it does require that you set it up at the project level, and you can break it down into much lower detail than you can typically in other parts of the system. And it does allow you to support expense items and products that typically are not part of the forecasting method within OpenAir. The downside of this feature is that it does not consider users. It really focuses on expense items, services, and products. So people are not a factor. So it's almost the anti-scheduling approach, because it does everything except for people, whereas the typical forecast uses people resources like timesheets and booking in the system. At a minimum, the intent of it was to help project managers keep on track of the budget burn for their projects, but it could be something as a source of information for forecasting. Now, forecasting expenses. So if you really needed to forecast expenses, and I've run into this before, OpenAir doesn't really forecast expenses natively. You can't sort of put a schedule of expenses in the system and have that be your forecast until the project budget feature came out. But if you're just using the standard charge projections, there is a way to sort of force the system to think about expenses. And really what that is all about is using generics. Take a generic, have the generic be a cost value of $1 an hour, and just put in 10,000 hours. And that's $10,000 of expense that you would forecast, essentially, in the system. And then, of course, as you put actuals in the system, then you'd be able to compare your forecasted expense plan versus your actuals in the expense plan against this generic user using custom calculations to create sort of a projected expenses reporting value to put onto reports. Same type of approach as you're using booking. The generic you would assign to a task. For assignments and for bookings, you would just basically make the person on a booking and do the exact same approach. So you're sort of faking out the entry of expenses for forecasting. Straight line forecasting ignores all of that because it just takes the budget and spreads it between start date and end date, so you don't really have specifically an expense approach. The resource scheduling would be basically the same thing as if you used the generic and sort of did the scheduling of the $1 an hour. But the project budget feature is the one that actually can do forecasting of expenses, because that's where you type in, I expect to burn this much in airfare these 3 months, this much in lodging this 3 months. So you actually put in a plan which you could essentially use as your forecast of expenses. So that's the only feature that really can support expense forecasting. So of course, getting all this infrastructure in place, picking the way that you want to do your forecasting or analysis, at the end of the day, you have to get the data out. You have to report on the data. So what are the key values that I'm looking for when I want to build these reports for my forecast? The key is look for 2 things. If you're using the standard charge projection functionality, you're going to look for 2 things in the reporting values, the word projected and then the word rules in brackets. Okay? When you see that combination, that is something that is coming out of the batch process called charge projection. It applies for charge projections if it's bottom up. It applies to the straight line forecasting. So in both of those situations, the reporting values all have projected and then the rules thing at the end. Of course, if you're doing anything with like the resource run rate, that target bill rate approach I talked to you about, that actually would just be your booking cost type thing. It would be the booking at the target bill rate value in the system. Okay. A thing to point out, depending on how you set up your report, so anything that you can run an actual report for, you should be able to run an equivalent forecast report for. But there is one key thing to note, and that is if you are using accounting dates in the system or accounting periods in the system, where your actual report is focused on the accounting information in the system. When you're doing forecasting, there is no forecast of an accounting date. That's a date that's applied by the execution of a rule. So if you have any of these reports that are using accounting date, if you change it to be a forecast report and you left the accounting date value as your date index, it's just going to assume that means transaction date. Just because there's no way OpenAir can guess what accounting period you'll happen to apply to a specific transaction. So it defaults back to the transaction date when you do the reporting for it. If you're doing the resource scheduling run rate approach, that sort of, something that you could do for like opportunity lost or capacity reporting or something, you could actually use these projected booking costs, projected work schedule costs, projected assignment cost values. And then if you renamed one of the cost levels target bill rate, it would show like the field name in the bracket. So target bill rate is something that I've renamed in my system as part of the setup of the users for the cost table. So cost here. Oh, and my team's already renamed it, but this should be target bill rate here. And then target bill rate would be something that would show up on the reporting values so that you could do reports and show the information that you want. If you did like the work schedule, what's the difference between the booking and the work schedule cost values here? The work schedule cost would be more of a capacity thing based, if you worked all the available hours in the company, if you worked those hours at your target bill rate, how much money would the company make? If you look at the bookings, it'll say if you actually worked what I plan you to work, this is the amount of money that you'll make. But you definitely, this run rate type reporting is good for comparison reporting. Can be used for forecasting, but it's a very, very simplistic approach to forecasting. And then finally, if you're using the project budget feature, which is the new feature, there's a number of new reporting values that became available by the fact that that has such a low level of detail that it can be coded to. And that is values called project budget labor, project budget expenses, and project budget purchases. So you can include those on your reports, and that would actually report the values as you put them into essentially a spreadsheet in the project itself to be able to do your forecasting. So at the end of the day, if you're looking at forecasting, what you're going to want to do is you'll probably want to put your forecast of billing and maybe compare that against a plan. Or maybe you're forecasting billing and cost and forecasting profitability. Or you're forecasting revenue and then checking that against your actual revenue. So there's a lot of combinations of fields, obviously, and so you end up having multiple reports probably to look at actuals and forecast as you work on how you want to view the data and how you want to manage the company in general. Okay. And finally, the forecasting capabilities in the system also warrant the ability for you to use calculations in the system to create your own type of reporting. The example on the screen here is where you're basically adding actuals and forecasts together so you get a total view in the system. And this type of calculation works because of how you set the pivot date. So you have to kind of keep all of this in mind, like how do you want to do the report, where is the value, where is the data going to be coming from, where are the controls as far as the pivot date is concerned. So like the example I used earlier in the presentation about I want to forecast from July forward. So basically if I run the report and I say give me projected billing from July forward, it'll have information in July and August and September. If I say give me the projected value in June or May of this year, those values will be 0 because I'm only projecting from July 1 forward. However, actuals are in my system for May and June. So if I run a project billing or an invoice amount in the system, I have numbers for May, I have numbers for June, and I have 0 for July because I have not actually done anything in July. So because you have 0 actuals forward and 0 forecast backwards, you can sort of add the two numbers together to get a total view. You won't double count anything because your forecast is controlled to be this month forward. Your actuals is basically last month backwards. And by doing this calculation, then you can get a total view in the system, actuals and forecast added together. Of course, this comes with a caution. The minute that you actually do, if I did an invoice in July in this scenario, then I would have actuals and forecast going on in the same month, and I would, by definition of this calculation, double count. So you do have to make sure that you're sticking with your processes and understanding who's doing what in the system as far as actuals are concerned. to make sure that your forecast doesn't accidentally double count. And then because of the straight line forecasting and the ability to do forecasting in general, should you start wanting to pull more sales-related methodologies into OpenAir where you're doing like weighted forecasting for pipeline, there are a couple of ways to do weighted forecasting with some custom calculations using a custom field like a percentage field, or even using a field called an allocation grid, which actually computes automatically a forecast percentage value based on what you type into the allocation grid. So something that typically is done in your sales system, your CRM, but if you start bringing early data into OpenAir, forecasting is something that if you do all the whole forecasting in OpenAir, you can also use the weighted values if that supports your methodology. So what I'm going to do now is I'm going to go ahead and open up the phone lines to see if there's any questions. This is a pretty complicated topic. We have about 9 minutes left. I'll open up the phone line, see if there's any questions I can answer. And of course, if anyone doesn't want to ask on the phone here, you can certainly send me an email and I can try and answer it through email as well. So 1 second here while I oh goodness, what happened to my controls here?
The conference has been unmuted.
Okay, so now we're cooking with gas. Did anyone have any questions that they were thinking about as we were going through the materials here on the forecasting capabilities?
Hey Jody, it's Richard Kersey. How are you?
I'm great. How are you doing?
Great, thank you. I have 2 questions actually.
Okay.
You mentioned that you could do booking type filtering with the projections.
Yes. Yes.
Where do you do that? In the report, or is it somewhere on the projection?
Yeah, you actually have to do it in the report itself, or depending on how the report is that you're building today, with all the features and the custom calculations, it may be something that you want to do as a custom calculation in the system where you're filtering on booking type. The only downside of the custom calculation approach is bookings, and I think there's a whole presentation we can do on custom calculations. But one of the rules of thumb in creating a custom calculation is if you have to do a filter where you're just saying, give me a booking and filter it by booking type, you still have to have an equation. So you usually do something times 1 or something -0, going back to your kindergarten type stuff, right? There's no way to sort of have a one constant against a booking and have it be something you can use. You have to use like a time entry or a budget or something like that. It's sort of a cross, but you can still get to it.
Or something like that.
Yeah, exactly. Yep.
And the second one is I think I have a way to manage the pivot date that is a little less crazy. And I just want to validate that it might make sense. On the report definitions with the new date filters that have been added to all the report definitions at the bottom,
yeah,
can use the metadata dates and control when to use projections and when to use actuals and not have to change it every time.
That is actually a really good point. So for those of you who may not be familiar with this topic. So we're talking specifically about summary reports in this scenario. And that's a really good tip. I like that tip. If you have some reporting controls turned on that basically add detailed date filters to your summary reports, they show up at the bottom here. Usually they're something that you scroll past really quick to get to the Save As option. But you'll notice that some of these actions here, some of these date filters are specific to charge projections. So here, the metadate that Richard's mentioning is a feature. It came out about 1.5 years ago. And what it supports is the ability to sort of put a relative value in there beyond what OpenAir's typical date controls are. So looking at this list, it looks pretty typical, but if you keep scrolling down, it gets a little bit more robust, like day of the week, parts of the month. Okay, it even understands future, past, accounting periods. So lots of flexibility here. And then to Richard's point, you could do something like only bring in the forecast from this Monday forward. Okay. And in fact, this actually works. So there are quite a few companies I know that have been wanting the pivot date to be something that could change on a weekly basis automatically, like a relative weekly one, and it's only available in a day, today or tomorrow value. So this would actually support that. Good, really good tip, really good find, Richard.
And then you can do the same with the actual charges and make it last month back or something.
Yeah, so that goes back here with the invoicing, wherever I have it in the system, invoice charges. Okay, past.
Past and then last month.
And then last month. Very nice. Look at that.
Okay, so that is a legitimate way to do it, right?
That is a legitimate way to do it.
Okay, good.
Applause all around. Any other questions out there from folks or tips like this is a great tip?
Jody, it's Alan Weinstein. On the
Hi.
project budget feature, if that gets flipped on, is there any negative impact on existing projects in the system? And I can use it on. Go ahead.
Sorry. What I was going to say is no, there's no impact on existing projects. In fact, the project budget feature is a standalone feature on the project. So in this situation, I have both of them turned on. Actually, the budget transaction feature, which has been around for a number of years now, and now the new one. And they don't interact with each other at all. The project budget feature is sort of stands on its own right now.
Thank you.
Mm-hmm. Any other questions?
Will this presentation be available as something that can be reviewed again?
Yeah. So what we'll do is we'll cut out some of this discussion when we post it on our website, because I just record like the pure slide set information. And then you can also request a copy of the slides if you'd really like. But it usually takes us a day or two to find the time to make sure we edit out the noise, and then we'll post it on our website. You're welcome. We've got almost 5 years worth of webinars on our website. so this one will be up there soon to join the crowd.